Imagine a single football field, just, a standard 100-yard field.
Right.
Now, visualize stacking it like maybe 10 meters high with these massive steel and concrete casks.
Which is just a crazy visual to begin with.
It really is. But that relatively tiny footprint, it holds roughly 90,000 metric tons of used nuclear fuel. I mean, it is literally all the commercial radioactive waste the United States has ever produced in its history.
The whole entire history of the industry.
Exactly. And for decades, that football field has been basically our most politically toxic environmental headache. Right?
Absolutely. The ultimate hot potato.
But today, we are plunging into the source material of a company that looks at that exact same footprint and sees basically a domestic energy reserve that rivals the oil fields of Saudi Arabia.
It's a massive paradigm shift.
It is. So welcome to Talk Tickers, your deep dive into the earnings calls that actually matter. Today, we are tearing into the Q4 and full year 2025 earnings print for Oklo.
Unpacking the real story for you, the experienced investor.
Right, giving you a clear-eyed synthesis of their financial reality and, frankly, some pretty wild strategic maneuvering.
Yeah, because the central tension we are dealing with here, it's really the defining dilemma of next-generation infrastructure for you guys modeling this at home.
The cash burn versus the dream.
Exactly. On one side of the ledger, you have this staggering, almost utopian promise, right, to completely reindustrialize the American power grid and solve the baseload energy crisis.
Which we desperately need.
We do.
Right.
But then on the other side, you have the immediate, just brutal reality of corporate cash burn.
Yeah.
I mean, this is a pre-revenue entity making massive promises about fundamentally altering the physics and economics of how we generate power.
While simultaneously asking the public markets to tolerate wildly expanding financial losses.
Right, an incredibly capital-intensive build-out.
So we're going to map out exactly how they plan to pull this off for you. We'll start with the immediate financial results and the market's reaction, which honestly is a psychological study all on its own.
Definitely.
Then we are going to dissect management's three-pronged vertical integration strategy. So that's power, fuel, and isotopes.
We also really need to explore this unique regulatory arbitrage they're utilizing.
Oh, for sure, because that's how they're actually getting steel in the ground while competitors are, still pushing paper around.
Exactly.
And finally, we will wrap up at the investment committee table with a highly aggressive, purely speculative trade pitch based on the data we uncover.
Can't wait for that one.
So let's just start with the raw fourth quarter and full year 2025 numbers.
Let's do it.
The headline is a GAAP earnings per share loss of 27 cents for Q4.
Right.
And that missed Wall Street's expectations by roughly 9 to 10 cents per share.
Yeah, and we should establish the baseline immediately here for you listeners. Commercial revenue currently sits at absolute zero.
A thorough nada.
Exactly. But for a company in this highly specific deep tech development phase, zero revenue is entirely expected. Right?
Yeah.
But that EPS miss matters because it indicates the sheer velocity of their spending.
The burn is accelerating.
Rapidly. The full year 2025 net loss widened significantly to $105.7 million. To put that in perspective, they lost $73.6 million in 2024.
So the engine is turning over, and it requires cash to lubricate it.
A lot of cash.
Yeah.
When you look at the operating expense mix, research and development for the year more than doubled to $58.9 million.
Oh.
And then general administrative expenses essentially tripled to $80.4 million.
Okay, wait, let me jump in here. Because I am looking at a pre-revenue company burning over $80 million a year purely on administrative overhead.
I know, it jumps off the page.
It really does. My immediate instinct is to just call that corporate bloat. I mean, if you are an investor prioritizing milestone velocity...
Right, getting to actual reactor deployment.
Exactly. Does a triple G&A expense signal a runaway startup culture? Or is it something else? Because sure, you cannot build experimental nuclear reactors across multiple states with like a lean team of 5 engineers in a garage.
Definitely not.
But 80 million is a massive number for admin.
It is, and it's the exact debate happening on trading desks right now.
I bet.
The bearish perspective sees that number and just assumes it's bloated executive compensation, unnecessary overhead, fancy offices.
Right.
But the bullish perspective, which requires looking at the actual hiring data, sees a totally different picture.
What are they buying with that 80 million?
That 80 million is buying regulatory compliance officers, hyper-specialized supply chain architects, site engineers, government liaisons.
The boring but necessary stuff.
Exactly. It's the mandatory, non-negotiable cost of transitioning from a futuristic whiteboard concept to active, simultaneous physical project deployment.
Oh.
Management explicitly framed 2025 as a, quote, step change year. They are no longer just designing a cool reactor. They are hiring the army required to build a vertically integrated utility.
And to fund that army, they have built an absolute fortress of a balance sheet.
They really have.
They ended the year sitting on $788.4 million in cash and equivalents.
Plus another $624.1 million in marketable securities.
Right, so that brings their total liquidity to roughly $1.4 billion.
A massive war chest.
And a big chunk of that was bolstered by a fully utilized $1.5 billion at-the-market, or ATM, equity program that they completed in early 2026.
Yeah, and for anyone unfamiliar, an ATM program allows a company to gradually sell newly issued shares directly into the secondary trading market.
Just drip-feeding it.
Exactly, at current prevailing prices,
Right.
rather than doing one massive, heavily discounted secondary offering that just crushes the stock.
Right. They essentially just bled those shares into the market over time to build this $1.4 billion cushion.
And having $1.4 billion in liquidity removes immediate existential financing risk.
Which is usually the #1 killer of hardware startup.
Exactly. You run out of money before you build the prototype.
Yeah.
But despite that huge green flag, the market's after-hours reaction to this earnings print was distinctly defensive.
Oh, yeah, they didn't like it.
No. Investors aren't panicking about 2025, though. They are aggressively chewing on the forward guidance for 2026.
Because management is forecasting operating cash use between $80 million and $100 million.
Right. But the true jaw-dropper, the thing that freaked the market out, was the investing cash outflow guidance.
The CapEx.
Yeah. They expect to push a staggering $350 million to $450 million out the door in 2026 alone.
I mean, that is nearly $500 million in capital expenditures in a single 12-month window.
It's massive.
You could only spend so much of that on engineers and lawyers, right?
Boy.
This indicates they are buying physical things, land, heavy machinery, securing long-lead supply chain components.
They are transitioning into heavy industrial procurement.
Which brings us to management's core narrative for you guys to understand. The 3-pillar platform strategy.
This is the key to the whole company.
They're structuring the business around power, fuel, and isotopes.
Right.
So power is the generation of clean, baseload electricity and heat. Fuel covers the fabrication and recycling of nuclear material. And isotopes involves harvesting highly specialized radioactive materials for healthcare and defense.
And the connectivity between these 3 pillars is what management refers to as their loop ecosystem.
The loop.
Yeah. Let's look at the legacy nuclear model for a second to compare.
Yeah.
It is a one-way, highly fragmented, friction-heavy supply chain.
Like a straight line.
Exactly. A mining company pulls uranium out of the ground. A different company enriches it. Another fabricates it. A utility burns it to make power.
And then finally, the federal government is tasked with figuring out where to bury the waste.
Which they historically fail at.
Right.
But what this company is attempting to build is a localized, repeatable loop. The power deployments create baseline demand for fuel.
Okay.
When they recycle their own used fuel, that chemical process inherently creates isotope co-products.
Interesting.
Right. They then take those high-value isotopes and sell them into specialized markets, which literally subsidizes the cost of the entire power generation operation.
Okay, I want to try mapping this onto an industry people interact with daily, just to see if the logic actually holds up. Imagine an electric vehicle manufacturer. They decide that just designing the car isn't enough, right?
Yeah.
They conclude they also need to own the raw lithium mines in Nevada. They need to build their own proprietary battery recycling plants. And they need to run a highly lucrative side hustle selling specialized chemical derivatives to the Defense Department.
That's a lot.
It's insane. Taking control of the entire vertical certainly prevents them from being squeezed by third-party suppliers, sure.
Yeah.
But does managing 3 distinct, historically difficult, highly regulated, heavy industry businesses exponentially increase their execution risk? I mean, it feels like juggling chainsaws.
It totally does. It is the ultimate double-edged sword of vertical integration.
Yeah.
If you operate purely as a reactor designer, your entire corporate existence relies on those third parties.
You're at their mercy.
Completely. If the global uranium supply chain bottlenecks and geopolitical tensions basically guarantee that it frequently does, your multi-billion-dollar business grinds to an absolute halt.
You literally have no fuel.
Exactly. By integrating, you take complete control of your destiny. But your EV analogy is apt regarding the risk.
Right.
Building a commercial sodium-fast reactor is historically a monumental task. Building a first-of-its-kind commercial nuclear recycling facility in the U.S. is equally daunting.
Just doing one is a career-defining achievement.
Attempting to execute both simultaneously while also scaling a medical isotope business requires a level of operational orchestration that very few management teams in human history have successfully pulled off.
Well, let's drill down into the first of those three chainsaws then. Power.
The main event.
Yeah, this is the primary demand signal. The absolute headline from the source material is the planned 1.2 gigawatt Aurora campus in Pike County, Ohio.
Backed by Meta.
Yes, backed by a prepayment agreement with Meta. And to contextualize a 1.2 gigawatt deployment for you listening, that is roughly enough power to sustain 1 million average homes.
Or in today's economy.
Or, exactly, it is the exact scale required to run one massive state-of-the-art artificial intelligence training cluster.
The AI tailwind is real.
It is. They are targeting an initial phase rollout of 150 megawatts around 2030. But the financial structure here is what really caught my eye. It is a prepayment agreement, not a traditional power purchase agreement or PPA.
And that prepayment structure is just an absolute masterclass in shifting risk.
How so? Walk us through it.
Let's break down how a standard utility PPA works. A developer agrees to sell power to a tech company at a fixed price per megawatt hour, starting, say, 5 years from now.
Okay, sounds normal.
It is, but the developer takes on all the macroeconomic risk in that scenario.
Ah, I see.
If the price of steel triples during the construction phase, or if labor costs suddenly skyrocket, the price they charge for power remains locked.
So the profit margins just evaporate.
Exactly, they get squeezed to death. But by utilizing a prepayment structure with a sovereign-level balance sheet like Meta's, they secure non-dilutive working capital up front.
Oh, that's smart.
They use the customer's cash today to secure land and procure early lead fuel items. It drives the project toward certainty before they ever agree to the rigid economics of a final binding PPA.
And the choice of location for this is highly deliberate, too. They secured over 200 acres in Pike County, Ohio.
Right.
Which, importantly, sits on the site of a former massive federal uranium enrichment plant.
And that specific geography creates an incredibly powerful halo effect for the project.
Because of the local sentiment.
Exactly.
Yeah.
When you are building nuclear infrastructure, the physical land is really only half the battle. The local psychology is the other half.
NIMBYism is real.
Extremely real. But the Pike County community is historically acclimatized to the nuclear industry. It's in their blood.
Right.
Plus, the site already possesses the necessary heavy industrial footprint. It has crucial water access for cooling. It has high-voltage transmission interconnects already in place.
So it's basically plug and play.
As close as it gets in this industry. When you combine a site with that specific legacy and attach it to the checkbook of a hyperscaler like Meta, it heavily de-risks the project for future federal and state permitting.
It signals to the regulators that this isn't just a speculative real estate flip.
Right. It says this is a critical national infrastructure priority.
Okay, but I need to challenge the firmness of this demand, though.
Fair enough.
Because management constantly references this, quote, healthy pipeline. And they speak about preserving optionality by not rushing into strict PPAs.
Yeah, they use those buzzwords a lot.
They do. But if you are an analyst trying to actually model future cash flows for this company, how do you value a binding commitment to build that lacks a specific price per megawatt hour?
It's tough.
I mean, a commitment to buy power is fantastic, but without knowing the revenue they will generate per unit of energy, calculating an internal rate of return on that Ohio campus feels like throwing darts in the dark.
It is. And traditional discounted cash flow models will just completely break down here. You can't use them.
So what do you do?
You have to value these agreements as real options. The market broadly recognizes that hyperscalers are locked in an existential arms race for compute power.
The AI wars.
Right. The demand curve for firm, non-intermittent power to run these AI clusters is essentially inelastic right now.
They just need the juice.
Exactly. The tech giants care far less about optimizing the marginal cost per kilowatt hour than they do about the sheer uninterrupted availability of the electrons.
That makes sense.
So while you cannot accurately model the exact margin spread today, the prepayment agreement serves as absolute validation of the physical demand. It proves the customer is willing to bear early-stage development risk just to get in line.
Okay, let's shift the focus from the planned site in Ohio to the active site in Idaho.
The Aurora project.
Yes, the Aurora project at the Idaho National Laboratory, or INL. This is where the actual physical execution is happening right now.
Steel in the ground.
Yeah, they have secured the Department of Energy Other Transaction Agreement under the Reactor Pilot Program, and their Nuclear Safety Design Agreement is approved.
Major milestones.
Huge. The materials highlight that they are actively doing site prep, literally blasting rock, and they have signed a major contract with Siemens Energy for the power conversion system.
Which is a massive signal.
It is. Their target for generating nuclear heat is 2028.
And in the glacial timeline of traditional nuclear construction, 2028 is essentially tomorrow morning.
It really is.
The contracting with Siemens is a vital signal to the market, too.
Why Siemens specifically?
Well, the power conversion system is the non-nuclear side of the plant. It encompasses the highly specialized steam turbines and generators that take the thermal heat from the reactor and actually convert it into electricity on the grid.
The actual money-making part.
Right. Sourcing those massive components from a Tier 1 global supplier like Siemens demonstrates they are moving past physics simulations and software models.
They're buying real hardware.
Exactly. They are entering heavy industrial procurement.
But, you know, Siemens can build the most efficient, beautifully engineered turbines on Earth, and if there is no heat to spin them, it is just a multi-million-dollar paperweight.
That is the hard truth.
Which perfectly transitions us to the second pillar, fuel.
The ultimate bottleneck.
Management explicitly stated in their commentary that fuel availability is the single most significant rate limiter for new nuclear deployment.
Without a doubt.
The global uranium supply chain is notoriously fragile, but they claim their specific technology, the sodium fast reactor, offers a massive structural advantage because it is incredibly versatile.
Yeah, they can burn almost anything.
Right. It can run on high-assay, low-enriched uranium, recycled transuranic fuel, and various DOE-managed materials.
And to understand why this fuel versatility is a legitimate competitive moat, you really have to understand the legacy constraints of the industry.
Give us the history lesson.
The vast majority of commercial reactors operating globally today are pressurized light water reactors. They require a very specific, rigidly formulated type of enriched uranium.
Okay.
They are incredibly picky eaters. If the global supply of that specific fuel is disrupted, those multi-billion-dollar power plants are just stranded assets.
Nothing they can do.
Right. Fast reactors, however, operate with a higher energy neutron spectrum.
Okay, let's pause on that phrase, fast spectrum, and break that down.
Sure.
Because it sounds a bit like sci-fi jargon. From what I understand, in a legacy water-cooled reactor, they use water to intentionally slow the neutrons down, right? Like putting speed bumps on a highway.
That's a great analogy.
And slow neutrons are highly effective at splitting standard common uranium atoms, but a fast reactor removes those speed bumps entirely.
No water to slow them down.
Exactly. The neutrons just fly around the core at incredible speeds, and because they retain so much kinetic energy, they can smash apart the heavier, more complex, stubborn atoms found in nuclear waste that, slow neutrons would just bounce right off of. Is that the basic mechanism?
That is exactly the mechanism. Because they utilize those high-speed, high-energy neutrons, fast reactors are basically the omnivores of the nuclear world.
I love that. Omnivores.
They can extract energy from a much wider variety of fissile materials, including the heavy isotopes that legacy reactors just leave behind as waste.
And they are aggressively building the infrastructure to feed these omnivores.
They have to.
They have the A3F facility at INL moving in parallel with the Aurora reactor build. That's to ensure that fuel fabrication isn't the bottleneck that delays that 2028 target.
Right, keeping it all in sync.
They also initiated site prep for the Tennessee Advanced Fuel Center, which has a rolling regulatory readiness review underway with the Nuclear Regulatory Commission for Long-Term Recycling.
Another massive undertaking.
But the piece that really caught my attention was the joint venture with Centrus in Ohio.
Oh, this is fascinating.
They're exploring, quote, deconversion services co-located right next to their planned Meta Power campus. So what exactly is deconversion, and why does co-locating it matter so much?
Well, when uranium is enriched at a facility like Centrus, it is processed in the form of a gas, specifically uranium hexafluoride.
Okay, a gas.
Right. And you obviously cannot put a highly volatile gas directly into a solid-state nuclear reactor core.
That sounds like a bad idea.
Exactly. So deconversion is the complex chemical process of taking that enriched gas and converting it back into a stable, solid metal or oxide form.
So it can be machined into fuel pins.
Exactly. By co-locating the deconversion and fabrication facilities right next to the enrichment plant and immediately adjacent to the power campus.
You eliminate the transport.
Yes, you eliminate the massive logistical friction, the insane security costs, and the regulatory nightmare of transporting highly enriched nuclear materials across state lines.
It's the physical manifestation of that closed-loop ecosystem they're talking about.
Precisely.
The source material also highlighted a massive milestone regarding safety validation.
The Nevada test.
Yes. They conducted a fast-spectrum plutonium criticality experiment at the Nevada National Security Site. They partnered with Los Alamos National Lab for this.
Heavy hitters.
For sure. They used a small plutonium assembly surrounded by a uranium reflector to validate their models on thermal expansion and inherent safety shutdown.
Passive safety.
Right. I find the mechanics of this passive safety absolutely fascinating. Can you explain how thermal expansion actually shuts a reactor down without human intervention?
Yeah, it's elegant, really. Traditional reactors rely on active safety systems. So that's pumps, valves, backup diesel generators.
Human operators physically inserting control rods.
Right, active things that have to happen to stop the reaction. But the fast reactor design relies on fundamental physics. As the metal fuel in the core heats up from the nuclear reaction, it physically expands, just like any metal getting hot. When the metal expands, the fissile atoms are physically pushed further apart from one another.
Oh, I see.
And when the atoms are further apart, the fast-moving neutrons are less likely to hit them and cause a split. So the reaction naturally and automatically slows down.
That's brilliant.
By putting thermal power into this small test system in Nevada and watching it naturally shut itself down purely through metal expansion, they validated that the core literally cannot melt down.
Physics simply won't allow it.
Exactly. It's fail-safe by design.
That validation is absolutely crucial because their ultimate goal, the absolute holy grail of this entire fuel strategy, involves handling highly sensitive material.
The 90,000 metric tons.
Yes, we are back to those 90,000 metric tons of used nuclear fuel sitting on utility pads across the country. Management is attempting to fundamentally reverse 50 years of established United States policy here.
It's wildly ambitious.
They want to shift the narrative from viewing this waste as a toxic geopolitical liability to viewing it as a domestic energy resource.
And that requires a monumental shift in national perspective. I mean, for decades, U.S. nuclear policy has been completely paralyzed by a single question. How do we safely bury this stuff?
Yucca Mountain.
Right. The political gridlock surrounding the Yucca Mountain repository has left this material permanently stranded.
Just sitting there in casks.
Exactly. Oklo is stepping into that void and saying, we don't need to bury it at all. We can chemically process it and burn it in our fast reactors.
Wow.
Because legacy reactors only extract about 5% of the energy potential in their uranium fuel. The vast majority of the energy is still locked inside that so-called waste.
It's just unburned fuel, really.
Precisely. If they can economically recycle it, it provides an essentially infinite, entirely domestic fuel supply that bypasses traditional uranium mining, milling, and enrichment entirely.
Okay, but let's inject some healthy skepticism here for our listeners.
Please do.
How realistic is this, actually? I mean, we are talking about building commercial-scale transuranic recycling facilities, something the U.S. hasn't done in half a century.
Right.
Do they actually have the political, regulatory, and financial muscle to pull this off? Or are they entirely reliant on the Department of Energy bailing them out through these innovation campus grants?
Look, it is entirely dependent on sustained federal alignment. The actual chemistry and physics of recycling used fuel are well understood. The French and the Russians have operated variations of closed fuel cycles for decades.
So it's not a science problem.
No. The barrier in the United States has never been the physics. It has always been policy, proliferation concerns, and just pure economics.
Right.
By aligning themselves tightly with the DOE's push for regional innovation campuses, they are attempting to draft off the government's momentum.
Following the federal money.
Exactly. They're making a massive bet that the federal government will eventually realize that subsidizing a private recycling facility is vastly cheaper and far more politically viable than trying to license and build a new national geologic repository.
Digging a hole in a mountain is expensive and unpopular.
Exactly. But make no mistake, it is an execution risk of the highest order. If the political winds shift in Washington, or if the NRC pathway gets bogged down in a decade of hearings, that transuranic fuel source remains permanently locked in those concrete casks.
Which perfectly transitions us into the third pillar, isotopes.
This is where it gets really interesting.
And what seems to be the absolute secret sauce of this entire enterprise, their regulatory arbitrage.
Yes.
Let's look at their path to near-term revenue. They acquired a company called Atomic Alchemy and just secured a critical NRC materials license for the Idaho Radiochemistry Lab.
A huge deal.
According to the documents, this is projected to generate the company's first actual commercial revenue this year.
And the psychological importance of that revenue for the market simply cannot be overstated.
Because it proves they're a real business.
Partially, yes.
Yeah.
When you are a pre-revenue infrastructure company burning hundreds of millions of dollars, you have to show investors a tangible path to cash flow to maintain your valuation.
You can't just be a science project forever.
Exactly. By securing that NRC license to handle, process, and distribute isotope materials, they immediately open up commercial sales channels into the medical imaging, industrial radiography, and defense sectors.
Real paying customers.
Right. It proves to the market that they can successfully navigate the labyrinthian NRC licensing process. And it provides a vital, non-dilutive revenue stream to help offset that massive $80 million corporate G&A burn we discussed earlier.
Okay, but the wildest part of the isotope strategy is the Groves test reactor.
Oh, this timeline is crazy.
They are targeting criticality for this reactor by July 4th, 2026.
That is literally months away.
For context for you listening, Groves is a pool-type, water-cooled, non-pressurized reactor named after General Leslie Groves of the Manhattan Project.
Great name.
It uses standard, commercially available, low-enriched uranium. But the speed of this build is what just breaks my brain. They went from a bare patch of dirt to a constructed structural facility in 5 months.
5 months in the nuclear industry.
It's unheard of. I was reading through their materials and came across this fascinating concept they're borrowing from the aerospace industry to explain this speed. The idiot index.
Elon Musk talks about this a lot.
Exactly. Am I right in thinking they are using this to explicitly criticize how legacy nuclear plants are built?
Oh, 100%. You have hit on the core of their manufacturing philosophy.
Walk us through it.
The idiot index is a metric popularized by commercial spaceflight companies to describe the ratio of the total final cost of a finished product compared to the raw material cost of its base components.
Okay, so finished cost versus raw materials.
Right. If a rocket costs 50 times more than the actual aluminum, titanium, and carbon fiber it is made of, it has an extremely high idiot index.
Because you're paying for all the middle steps.
Exactly. It means you are paying massive synthetic premiums for convoluted manufacturing processes, monopolized supply chains, and just insane bureaucratic overhead.
Right.
Management is directly mapping this concept onto the nuclear industry.
Okay, let's look at legacy pressurized water reactors through that lens then. Because they operate at incredibly high pressures, the entire supply chain requires exotic, heavy forged pressure vessels, highly specialized nuclear-grade concrete, and bespoke, incredibly expensive pumps and valves.
Right. None of it is off the shelf.
There are only, a handful of forging facilities on the entire planet that can even manufacture a traditional reactor vessel.
Exactly. That creates a massive idiot index.
But because Oklo is building sodium-fast reactors, and in the case of the Groves facility, a completely non-pressurized pool reactor, they don't need to operate at those extreme physical pressures.
Exactly the point. Because they remove the pressure, they completely remove the need for those bespoke, hyper-expensive components.
The expensive forgings.
Yes. Management stated they are sourcing up to 70% of their physical components from standard, non-nuclear industrial supply chains.
So just normal industrial catalogs.
Basically, yeah. They can use seamless, off-the-shelf alloys.
Yeah.
They can use common, industrially available seals and valves that are used every day in chemical plants and refineries.
Wow.
They are systematically bypassing the nuclear idiot index by flat out refusing to play in the legacy pressurized water reactor sandbox.
And that physical supply chain arbitrage is paired perfectly with their regulatory arbitrage.
Which is the most important part of this whole story.
I want to make sure I understand this correctly for our listeners. They are utilizing two entirely different licensing pathways simultaneously.
Right.
For their first-of-a-kind developmental assets, so that's like the Aurora reactor at INL, the A3F fuel facility, and this Groves test reactor, they are using the Department of Energy authorization pathway.
Yes.
But then for their commercial-scaled build-outs like the Ohio Meta campus and the Tennessee Recycling Center, They are pursuing the traditional Nuclear Regulatory Commission, or NRC, pathway.
Yeah, exactly.
So why does splitting the regulatory strategy like this save them so much time?
Okay, the NRC pathway is fundamentally predictive, whereas the DOE pathway is empirical.
Break that down.
Let me expand on an analogy. Imagine trying to get a license to manufacture a totally new type of car.
Okay.
The traditional NRC process is like being forced to pass a 10-year written exam where you have to mathematically prove, using advanced theoretical models, that your car will never, ever crash under any conceivable circumstance before they even let you build a prototype.
So it's all just math and paperwork up there.
Mountains of it. Decades of it.
Yeah.
The DOE authorization pathway, utilized under their reactor pilot program, is like being handed the keys to a closed, highly secure government test track.
Oh, I see.
The DOE allows them to actually build the physical car, crash it into a wall a few times to physically observe how the thermal expansion limits work, and then use that hard physical data to write the ultimate safety manual.
That makes so much more sense. So they are pouring concrete, bending metal, and testing the system integration today.
Right now.
They are capturing the physical lessons learned in real time, which they will then package up and hand to the NRC when it is time to transition those commercial sites to traditional oversight.
Exactly.
It is the difference between writing a 10,000-page thesis on theoretical safety versus just showing the regulators a physical machine and saying, look, the brakes actually work.
And that velocity, that physical action, is precisely what justifies that staggering $350 to $450 million capital expenditure guidance for 2026.
That's where the money is going.
Exactly. They aren't burning cash on theoretical paperwork. They're paying a premium to rapidly pull the physical construction schedule to the left.
Okay, let's pull the lens all the way back here and look at the investor context and the macro tailwinds driving this entire sector.
It's a perfect storm.
It really is. When you factor in the recent Advance Act, sweeping executive orders, and federal support mechanisms like production tax credits and DOE loan guarantees, we've transitioned from a light regulatory tailwind into a hurricane-force macro tailwind for U.S. nuclear policy.
The federal government has explicitly realized that reindustrializing the nation's manufacturing base requires massive, localized amounts of power.
You can't build factories without juice.
Exactly. And intermittent renewables like solar and wind, while crucial, they simply cannot physically balance the grid at that scale without relying on natural gas peaker plants.
They need baseload.
But the true structural alteration of the utility landscape is being driven by the artificial intelligence sector and data center expansion.
Big tech is actively bypassing traditional grid utilities to contract directly with nuclear developers.
They're skipping the middleman.
Yeah, because a gigawatt-scale AI training cluster cannot afford to power down when the sun sets or the wind stops blowing.
The GPUs have to run.
They require 247 firm, clean baseload power to justify the billions they are spending on those advanced GPUs. And this dynamic is structurally changing how infrastructure is valued by the market.
So the bottom line for investors attempting to navigate this earnings print is clear. The balance sheet is heavily de-risked for the next several years.
So $1.4 billion.
Right. They absolutely have the capital required to execute their immediate plans.
Right.
But the power generation side of the business remains entirely pre-revenue.
It's all potential.
Therefore, the valuation of this equity will gyrate violently over the next 24 months based entirely on milestone velocity.
You are watching for those DOE authorizations to convert to operation. You are monitoring the Ohio site preparation for actual physical progress.
Right.
And you are absolutely holding your breath to see if they actually hit that July 4th criticality target for the Groves test reactor.
And let's be clear. If they miss the Groves deadline by a significant margin, the market will severely punish the stock.
Oh, it'll tank.
The street will interpret a delay as proof that even with non-nuclear supply chains and the streamlined DOE authorization, the physical realities and delays of nuclear construction are just inescapable.
Nuclear is always late, basically.
Right, that's the stigma. However, if they hit that date, it forces a massive, fundamental re-rating of their execution credibility.
Which brings us to the investment committee table.
My favorite part.
It is time for a wild, yet highly plausible trade pitch based on the data we have just unpacked. As always, a disclaimer for you listening. This is for educational and entertainment purposes only. Do your own deep research. This is not financial advice.
Not financial advice.
Okay, looking at the options flow data in the source material, the pre-earnings volume ran about 1.5 times normal, with calls heavily leading puts.
Very bullish positioning.
The market was pricing in a massive 8% implied volatility move. But what really stood out was the unusually heavy, concentrated activity in the April $40 calls.
Someone is making a big bet.
Yeah, the market is pricing in violent near-term volatility. How are you positioning a trade around this exact setup?
I'm pitching a pair of ideas today based on the behavioral psychology of the market right now. Let's start with what I call the July 4th ignition butterfly.
Catchy.
Thanks. This is a highly specific catalyst-driven play targeting the Groves test reactor milestone. Right now, the broader market is aggressively discounting the near-term upside of the stock because analysts are just choking on that 350 to 450 million CapEx guidance for 2026.
They see the burn and panic.
Exactly. They see the cash burn, they get defensive, and they assume delays. You use that fear to your advantage by executing a calendar call spread.
Hold on, let's play proxy for a listener who understands standard equities but, doesn't trade complex options daily.
Sure.
Walk me through the actual mechanics of a calendar spread here. You are saying we actually want to intentionally sell the near-term upside calls.
Yes.
Why would I cap my near-term profits if I fundamentally believe they're going to hit criticality at Groves in July? Shouldn't I just buy straight call options and wait?
It comes down to implied volatility crush in the cost of capital. Right now, options premiums are highly inflated due to the earnings volatility and the massive CapEx fears.
The IV is juice.
Very juicy. If you just buy naked calls, you are paying a massive premium. And if the stock trades sideways for 3 months while they, just pour concrete, those options bleed out from theta decay and expire. Completely worthless.
You lose it all while waiting for the catalyst.
Right. But in a calendar spread, you sell the near-term front month out-of-the-money calls. You harvest that inflated premium from the fearful market today.
You collect the cash.
You then use those cash proceeds to finance the purchase of long-dated out-of-the-money calls expiring in August or September, well after the July 4th catalyst.
Oh, I see. So you are letting the near-term expensive options expire worthless during the quiet construction phase.
Right.
Essentially letting the market fund your lotto tickets for the late summer catalyst.
Precisely. Because if they pull this off and achieve criticality at Groves by July 4th, proving they took a nuclear test reactor from a bare field to active operation in under 10 months, they unequivocally prove they have beaten the nuclear idiot index.
The narrative changes overnight.
The stock fundamentally re-rates overnight from a speculative storyteller to an aggressive execution machine. Your long-dated August calls capture that massive structural re-rating, and you finance the whole trade using the market's near-term anxiety.
I love the mechanical efficiency of that trade. What is the second pitch for the committee?
The second idea is a broader macro structural pair trade. I call it the legacy fuel short.
Okay, lay it out.
You go aggressively long Oklo, and you strategically short a basket of legacy, light water, small modular reactor competitors.
So spicy.
The thesis here relies entirely on the regulatory arbitrage we discussed earlier, acting as an insurmountable competitive moat.
So you are placing a bet on the regulatory pathway, not just the underlying physics of the reactors.
Yes. While the legacy SMR competitors spend the next 4 to 5 years burning hundreds of millions of dollars just to push theoretical paperwork through the NRC to get permission to build their very first test units.
Oklo is already building.
Oklo is physically building under the cover of the DOE. They are utilizing non-nuclear supply chains, pouring concrete, bending metal, and preparing to iterate.
Wow.
You are essentially shorting the bureaucratic gridlock and bespoke supply chains of pressurized water reactors and going long on the physical construction speed of unpressurized sodium-fast reactors.
So you are betting that the paper pushers will bleed out their startup capital before they ever turn a single shovel of dirt?
Exactly.
While the team actively blasting rock in Idaho runs away with all the lucrative hyperscaler prepayment contracts.
Winner takes all.
That is a vicious, completely plausible thesis for the committee to chew on.
It separates the companies that are building CAD models from the companies that are building physical infrastructure.
Well, let's recap the core takeaways from this deep dive for you guys listening. We are looking at a company heavily capitalized with over $1.4 billion in liquidity.
Very well funded.
They are burning cash at a rapidly accelerating rate, driven heavily by R&D, structural headcount, and massive footprint expansion.
350 to 450 million in capex coming up.
Right. But they are actively, aggressively laying the physical and regulatory groundwork for a vertically integrated nuclear monopoly spanning power generation, fuel recycling, and specialized medical isotopes.
Doing it all at once.
They are leveraging non-nuclear supply chains and unique DOE regulatory pathways to bypass legacy bottlenecks.
They are basically running a high-stakes, incredibly capital-intensive sprint to prove their platform model works in reality before the market's patience for cash burn finally runs out.
I want to leave you with a final, lingering thought to mull over. Let's assume this multi-pronged strategy actually succeeds.
Best case scenario.
Right. Let's assume they perfectly crack the code on commercial fast-spectrum transuranic recycling, and they start commercially burning that 90,000 metric tons of used nuclear fuel currently sitting on utility pads across the country.
The football field.
The football field. We are looking at a future where the United States' largest, most profitable energy supplier might never need to mine a single new ounce of uranium.
Which is wild to think about.
They simply feast on the waste of the 20th century. What does that do to the global commodity markets in the 2030s when the world's largest consumer of nuclear fuel suddenly becomes entirely self-sufficient on its own recycled waste?
The uranium market would collapse.
It is a structural paradigm shift in energy independence that the commodities market hasn't even begun to price in.
It radically redefines the geopolitics of energy overnight.
Something to think about. Remember, none of this was financial advice, just the start of your own deep research.
So do your homework.
Reach out with your models, your pushback, and your own structural trade ideas. Thank you for joining us on this deep dive.